I would just tell you not to fixate on it. Like the best way to think about what's taking place right now in the market below the surface at the index level is that new groups are taking market cap away from tech. And as that process continues, it could go on for a really long time. Technology got to like 26% of the S&P 500. It's not that it's a small industry, it's a huge industry, but that's way outsized relative to, for example, employment. Only 2% of the labor force works for technology companies. So we've really just had outsized representation. There were good reasons for it. These were the highest quality companies with the strongest balance sheets, with the fastest earnings growth, with the most visible innovation. Like, it made sense while it was taking place. What we're living through now is just a little bit of an unwind, and it won't be unwound all the way. But if I told you a year from now technology might be only 20% of the S&P, down from 23% currently, you probably wouldn't argue with me. And maybe the most interesting question to ask is, well, what's going to pick up those 3 percentage points? And that's what I try to think about. So I wouldn't focus too much on the NASDAQ. I would just focus on, like, what can I do that's productive away from what's happening there. But
I just wonder, Bryn, are these no longer then the best companies, the companies with the best balance sheets, the companies with the best growth? I'm just reading exactly what Josh just had to say about these companies. Are those days over? It feels like they're not, like they still are all of those things. Or maybe I'm wrong.
Well, they definitely have some of the most pristine balance sheets without a doubt. If you look at, I mean, even Facebook, you have Microsoft, Apple, Google, incredible balance sheets. But to build a little bit on what Josh said, is going into this year, the Qs had an average annualized 10-year return, Scott, of almost 20% per year. Even with this 30% sell-off, the Qs have still averaged 16% a year. And if I go back and look at the valuations 10 years ago, they were a fraction of what they are today. And so I think a tech across the board over-earned, especially the last 2 years, and we're peeling some of that back. And you know what I think through is not only where are we in the return cycle, which I just walked through, tech is over-earned, but where are we in the economic cycle? And if you just look at this year, and I have felt that we are late stage, is that what works well in late stage? Consumer staples, utilities, and healthcare. Well, after late stage, what happens? A recession. What works well there? Consumer staples and healthcare. And what doesn't work? Tech and financials. And so as I look out next year, I want to continue to underweight tech and own other asset classes. I love selling calls. And I think ultimately, tech is the trade after the trade that people should be looking for. Because look what's happening in China. China was in a recession, looks to be coming out because they're opening up, you know, temporarily. And what's been running? High beta tech in China. And so I think tech will run again, but I think you have to look at later on in 2023, after we get a slowdown in the economy, until tech really is able to work off some of these multiples and potentially regain its traction.
Weiss, how do you see this critical question for investors? Because so many people were in these stocks and they're still sitting in there. Unfortunately, they've endured a lot of pain. Well, I know because I hear from a bunch of them who want to know when this is going to reverse. And I don't know what the answer is. Do you?
I don't know exactly what the answer is, but I'm happy to offer an educated guess. It's not going to reverse till the second half of next year. Tech will reemerge as the market leader because they are the best earning companies. They do have the best growth prospects, and they are the less cyclical. So right now you're seeing a move into value, which is defined as industrials, even though their PEs exceed some of the tech PEs. I think actually they're going to suffer a world of hurt in the first and second quarter. So when you see that happens, as the market bottoms, which I believe will be sometime in the second quarter, money will come back into tech because it should. Because, as I said, that's where the growth is. That's where the balance sheets are, as the others have said as well. In the interim, though, it still is at volatility, and it still is suffering a hangover where their PEs were expanded. And until the market stops using the metric of 2021 and 2020 as to where the stocks are, and they're cheap because they're down 50% or 30%, they're not cheap. Those were illusory multiples based upon free money. So
none of these, do any of these, I'm sorry to interrupt you.